Stocks are trading lower here today on news that the economy is slowing faster than what we expected. New job openings are under 10 million for the first time in over 2 years. Also, Jamie Dimon, head CEO of JPM for about 20 years now, says the banking crisis is not over yet and will have rippling effects in the economy for years to come. All of this spells bad news for a recent rally in specifically the tech sector that is now, quite frankly, in another bubble. We're going to get into all of the major events that you need to know throughout the rest of this week and just what's going on. So, buckle up, guys. Hit that like button if you have not already. It is free $99, and consider sticking around a while and hitting that subscribe button if you learned something out of this video. Now, S&P 500 down about 0.5% today. NASDAQ down about 0.5% today. Russell 2000 down about 2%. This is really showing you your small and mid-cap companies are getting obliterated today. That is because they are most sensitive to a downturn in the economy. And that's exactly what is starting to happen. And take a look at this. Job openings tumble below 10 million in February for the first time in nearly 2 years. The expectation was for about 10.4 million job openings. Job openings came in at 9.93 million, a drop of 632,000 from January's downwardly revised number, according to the Labor Department's JOLTS report. Now, it's going to get more interesting than that later on throughout this week, and we'll talk about the other data points here in just a second. But this is really highlighting, and I want to be clear, the economy is slowing down. After all, when Google starts to cut back the amount of staplers that they are willing to give to their employees, hey, you got a problem. And that's exactly what markets are starting to see. Because technology specifically was up 24% in Q1 from the lows to where we closed. That only happens if the economy can go through a soft landing. It's starting to look more and more unlikely that that actually happens. And a weakening economy is going to make the CPI reports much more important, because the Fed is willing to give us a deep, dark recession if we have to get inflation under control. So the upcoming inflation report and that CPI report coming on April 12th is going to be of the utmost importance. Now, the second biggest news of the day is not Trump being arraigned. No, it's Jamie Dimon that says the banking crisis is not over and will cause repercussions for years to come. Quote, the current crisis is not over yet, and even when it is behind us, there will be repercussions from it for years to come. Quote, but importantly, recent events are nothing like what occurred during the 2008 global financial crisis. This is kind of in line with what we have heard for weeks now. The banking system is sound and resilient, much the same as what we heard during 2008. Jamie Dimon reiterating that this is not over is not good for the markets, especially when the economy is starting to turn pretty quickly here. So that's the second bit of information that we are getting today. You also had a manufacturing production that was down sharply as well, more than expectations, and that is also not good. Not a good sign for the economy. Now, if we take a look at the economic calendar, this is a free tool. I highly recommend every single one of you guys use it, especially if you are trading in this very volatile markets. Trading Economics /calendar, look it up, easy to find. It will give you all of the data points really from around the world. Well, the only thing that really matters is the American markets. And Canada, to a lesser extent, Europe as well. But when it comes down to things that move our markets, it's really the United States. And you can see important data points will be highlighted in red. And for tomorrow, for Wednesday, you're going to get the balance of trade. It's highlighted in red. It does not cause a move in our markets all too often. The balance of trade continues to be negative. Look at the deficit. Hand in hand, right? It doesn't tend to give us a big move. That comes out at 8:30 in the morning, expecting a negative deficit, a trade balance of $69 billion. As well as that at 10 o'clock in the morning tomorrow, the ISM non-manufacturing PMI for March. PMI above 50 is positive, right? PMI under 50 is negative. You're expecting a reading of about 54 from the previous reading in February of 55.1. Now, if we take a look at Thursday, Thursday is actually going to be the last day of trading for this week, and you are going to get the unemployment rate for Canada coming in at 8:30 in the morning, as well as initial jobless claims coming in for America at 8:30 in the morning as well. What is most interesting about this week is we are closed on Friday, the same day that we get the unemployment rate as well as the non-farm payrolls for March. And these data points come out at 8:30 in the morning, but the markets are going to be closed. So you're going to get a delayed reaction, which will then come on Monday. And the unemployment rate for March is expected to come in at 3.6%. February's unemployment rate was also 3.6%. Non-farm payrolls for March, you're expecting a sharp downturn to 238,000. Non-farm payrolls for the month of February came in at 311,000. And if today is any leading indicator of how the markets are going to feel about economic data, specifically over the next coming months, it's if the economic data shows the economy is slowing down, that's going to be negative. So if you start to get the non-farm payrolls potentially dropping by even more than 238,000 jobs, well, that's going to be a very negative thing, because ultimately the reason the market sold off in 2022 was because of fears of a recession. Well, now that we're getting close to this recession, you are seeing safe haven assets starting to outperform. In Q1, large technology carried the markets, and that's because they have very robust balance sheets. They don't need outside funding. The chance of them going bankrupt is very, very low. They're seen as safe havens in this market. Whereas bonds did well in Q1, gold did well in Q1, your safety plays did well in Q1. At the same time, technology did well, which is, again, broadly speaking, technology is not really your safety trade. Your top 5, top 10, largest tech companies are seen as safety trades in 2023. So like we're seeing today, if data shows the economy is continuing to slow, that is going to be very, very negative. At the same time, if inflation does not fall, that's where you could get a very real downturn in this market with very short notice. After all, the markets care about a recession more than anything else, and markets are currently expecting 4 rate cuts by the end of this year, which does not look all too likely if inflation does not continue to fall. Now, if we take a look at the Fed rate monitor tool, right now markets are expecting the Fed is going to pause coming on May 3rd with a probability of about 55.4%. 44.6% of investors are expecting the Fed to hike rates by 25 basis points. And this probability is flipping here today, mainly because of the weak economic data that we are seeing. The previous day probability was 60% chance of a 25 basis point rate hike. That is falling today to 44.6%. So economic activity falling. While it's good for Fed policy going ahead, it's only good if inflation continues to fall. And that next CPI report is going to be on April 12th, guys. Another big reason why the markets have been rallying as of recently is the Fed's balance sheet. This is something you want to watch pretty closely here, especially if you are trading in this market. If the Fed balance sheet does start to go down, that's going to give you some down moves in the markets. The balance sheet increasing leads to stocks going higher. When the balance sheet falls, that always leads to stocks falling, as the correlation has been since 2008. And it's no shocker that markets have been so bullish since 2008. It comes down to the Fed balance sheet and mostly algorithmic trading programs that are really fueling a lot of this move. Now, Wednesday, pre-market, so tomorrow, you're going to get Conagra Foods that reports, Conagra Brands. And that will be important as far as food inflation. That is a large component of CPI. That's a big problem. We know this. We're going to get some insights from Conagra Brands coming tomorrow morning. Now, Thursday, pre-market, you're going to get Constellation Brands as well. Think Modelo, think Corona, think different beers. Constellation Brands is your guy for that. So you're going to get some demand, implications from Constellation Brands as well. Thursday after hours, Levi's, WD-40. I think Levi's speaks for itself. Kind of consumer discretionary kind of item, will be important for how consumers are starting to spend money and could have bigger implications for the broader economy. But that's really it as far as earnings. Next week, you're going to kick off and start to get into bank earnings. And bank earnings, considering the banking crisis that we have been seeing, could be another big round of fear starting next week, guys. So that is going to do it for today and the major events throughout the rest of this week. If you learned something out of this video, you like my perspective, you like the raw information, hit that like button and subscribe to the channel. Thank you guys for watching. Most importantly, enjoy the rest of your day, and I will see you in the next one.